All right, everyone, we'll get this show on the road. I want to thank everyone for joining us today for another one of our great presentations on the options you have with self-direction. And today, specifically, we're going to be focusing on what to do with your old 401k, but this just doesn't center on 401ks. It's any old type of employer plan. We're going to go over some of the basic options that you have, how to move those funds over, what you can and can't do with them, to give you kind of a very basic working knowledge of what to do with those funds that are just kind of sitting there that you obviously don't want to take out and take a large tax or penalty hit for, but still would like to get them invested in maybe some different alternatives for you. My name is Alex Perny. I'm a Certified IRA Services Professional here with Advanta IRA. My contact information is here on the slide. If you have any questions afterwards, feel free to reach out and ask me directly. The contact information will be provided at the end as well. Throughout the presentation, I do ask that you type in your questions to the chat box as your microphones are muted, so please do let me know if you have any questions. It does help to enrich the presentation. You might be helping someone else, or if you have a question, please do not hesitate to type those in and I will address them as they come up. Thank you for doing that. Again, also the raising a hand function has been disabled as well, so please do type your questions in and I will address them as they come up. Now, obviously, before we get anything started, we have to make the attorneys happy. So Advanta IRA and our employees, we do not provide legal, tax, or investment advice, nor do we endorse any investment products. All informational materials today are provided for educational purposes only, and all parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. So people often wonder, what is a self-directed IRA? You might have heard the term being used loosely or never at all. It really just refers to the type of IRA structure where you can have the control in order to invest in things that you know and understand, or maybe things that are a little bit more tangible than what are offered at your traditional brokerage houses, in order to build tax-free or tax-deferred income for your retirement savings plan. Now, if you have any questions specifically if something works directly into a self-directed IRA, by all means, please feel free to ask, but it just refers to essentially the type of investments that you are making in the IRA, because ultimately who determines what types of investments can be held in an IRA, besides the few basic guidelines that we will get to in this presentation, is going to be the IRA custodian, in this case someone like Advanta, or in a more traditional sense maybe someone like Fidelity, are going to choose what they will and will not hold. So that's kind of where the delineation comes between where a company like us specializes in holding real estate. We do not specialize in holding things like equities and stock, just like someone like Fidelity does not specialize in holding things like real estate, so we make those decisions as to what we will focus on and allow our clients to pursue. And again, this term self-direction, it does not just center specifically to real estate, although that is primarily the bulk of the business that we do administer. You can also hold notes and mortgages, so you can be a private lender in your IRA. You can invest in private placements, precious metals, foreign currency, all sorts of different interesting stuff. So don't think that you're just limited to one type of specific investing. A little bit about us: we have well over 20 years of combined industry experience with our employees and our management staff. We've been in business here since 2004. We just reached a great milestone this year in administering over $1 billion of assets for our clients, as well as administering them through networks of trusted CPAs and attorneys as well. So we do, anyone that is here that is a client, thank you for helping us reach that. And anyone that's curious to know more about this, we'd love to have you in the family in order to help grow that with you. We do hold all of our cash in FDIC insured accounts, so the traditional banking protections that you are used to is still maintained here at Advanta. You're not giving up in any type of traditional protections that you would be used to at a regular brick and mortar bank in order to do self-direction. So just understand that although you are gaining a lot in flexibility and the types of assets that you can hold, you're not giving up any type of traditional protections that you're used to. So the old give and take really doesn't apply too much in that scenario, so that is a very good thing. And getting started with this kind of stuff is inherently very easy. The first step is essentially just opening the account, then funding the account from the existing 401k or other type of retirement plan that you do have, and then you can get started investing. So the barriers to entry are very minimal, and the ability to really expand the breadth of what you are investing in is great with this type of product. And if you have any questions, again, always feel free to reach out to us. My contact information will be at the very beginning and end of this presentation, but the consultations with us are always free. There's no obligation if you want to give us a call and sit down and talk with us about the questions that you have. And if we can be a good fit, we'd love to move forward with you. But ultimately, sometimes we can also figure out if something else maybe would work better for you. But please do always give us a call. Let us help you figure it out and get you on the path to taking back some of that control that you might be missing out on with things still sitting in an old employer's 401k or old employer's plan as well. Now, understanding the different types of plans that are out there is inherently going to be very important when understanding what to do with that old 401k you have, because 401ks are going to be structured in a few different ways. One, you're going to have the 401k that is going to be, in the most traditional sense, a traditional 401k, meaning that your employer and yourself both contributed funds into that on a pre-tax basis, meaning that both of you got deductions or were able to deduct the amounts of money on your personal or corporate tax returns that went into that type of account. So everything is growing tax deferred, meaning that the type of account that you're going to roll that one into would be a traditional IRA. A traditional IRA being a tax deferred individual retirement arrangement. Now, 401k plans after I believe it's after 2001 could have a Roth component, meaning that instead of contributing as the participant of that plan on a deductible basis, you were then contributing on an after-tax basis. Now, by contributing on an after-tax basis, it moved it into the realm of having already paid the taxes, so therefore all of the earnings would grow tax-exempt, meaning that those types of accounts, being a Roth 401k, can be directly rolled into a Roth IRA. Now, just an interesting piece of information is that a Roth IRA cannot be rolled into a Roth 401k. Strange rule, I know, but it is out there. So understanding what type of 401k you have is going to really kind of set you up for what type of plan that you were going to roll into. If you had taken deductions for the entirety of the life cycle of that old 401k, you're going to be rolling that into a traditional IRA. And 401ks can have both deductible and non-deductible contributions in them. So you might inherently have to roll it into two separate different accounts, a Roth IRA and a traditional IRA. Now that's really important because depending on where you hold the bulk of your capital, you're not necessarily always going to be investing as a singular account like you were with the 401k. You're going to have to look at it as two separate entities kind of going forward, because you're going to have to split that up coming out. You can't just take the 401k and put it all into a singular IRA if you have deductible and non-deductible contributions in there. So understanding what types of accounts that they can go into is important as well. Now, obviously, there's more than just the traditional and Roth enumerated on this slide. So what does that mean for your old 401k? Well, two of these aren't necessarily going to apply to the 401k aspect, but three of them are. The three that are going to apply to a 401k direct rollover that you have an option for are the SEP, Simple, and Individual K plans. Now, if you had worked for a company for many years, let's say you'd worked for a large company, call it GE. You had worked for them for many years and had a sizable 401k plan. And then you changed directions. You decided to retire from that job, and now you are, let's say, working for yourself as a self-employed individual or a sole proprietor, and you'd like to still have the high contribution limits of that old 401k plan. Well, instead of just rolling into a traditional or Roth IRA where your contribution limits are going to be capped at $6,500 or $5,500 a year, depending on your age, maybe you want to set up something like a SEP IRA or an individual 401k or a simple IRA in order to have higher contribution limits associated with your new business. Now, you can roll an old 401k into one of these types of plans. However, if you do have a Roth 401k, it can only roll over into the Roth component of another individual 401k plan. SEP and simple IRAs do not have any type of Roth provisions, so you can only take deductible basis contributions from an old 401k and roll them into either of those types of plans. Now, the nice thing about a SEP IRA specifically is that you can contribute much higher amounts than your traditional or Roth IRA, to the tune of up to 25% of your base compensation, not to exceed $55,000 for the taxable year of 2018. So with that said, if you are a self-employed individual, having the ability to take that old 401k, roll it into your new self-directed SEP IRA plan is going to allow you much higher contribution limits and allow you to move that capital basis that you have in your 401k to another qualifying type IRA plan to maintain those tax-deferred investment benefits. Now, one important thing to note is that with an individual 401k, you still get the same contribution limits as you did with your old 401k plan, but you get much tighter control of it. Now, people sometimes misunderstand with their old 401ks what exactly the matching component of that plan is. So when most people look at a 401k plan, you'll see something like, you can participate in this plan. You can contribute up to $18,000 if you're under the age of 50 with an additional $6,000 of personal contribution after the age of 50, and we will match 4% of your base compensation into that plan. Well, where do they get that 4, 3, or 2, or whatever percentage they're matching from? Well, what it is that you can contribute up to 20% of your 25% of your net operating income into the plan per participant per year, not to exceed $35,000 per participant. So you potentially have another $35,000 if you are utilizing a solo individual 401k self-directed plan that you can put in there if you have net operating income as well. So the ability to play around with your contribution limits from the perspective of self-administering your 401k if you have a qualifying business now is going to be really exciting for that as well. So understand that you can get a pretty sizable amount of money into a 401k plan if you are a self-employed individual that has an old 401k that you'd like to roll over. Now, the education savings account and the health savings account are not things that can be directly funded via a direct 401k rollover, so you will have to fund those a little bit differently. We teach classes specifically on that, but I do like to make sure that every one of my presentations covers at least the basic types of self-directed plans that you can hold with Advanta. Now, just to make sure if you are viewing this on YouTube that we do enumerate this, so here's the slide that you can capture for the contribution limits for 2018 that you can put into any of the types of plans that we previously just looked at. Now, understand that your contribution limits and your rollovers do not affect each other. So you can roll over a $250,000 account to a traditional IRA and still make a $6,500 or $5,500 contribution if eligible for that taxable year. So understand you're not going to be precluded from doing anything just because you do a rollover. Your contribution limits and rollovers are going to be completely separate. And understand that the amounts of direct rollovers you can do are not going to be limited on any given year. The only time you are limited on a rollover is if you take the money out of the 401k plan, deposit it personally to your personal accounts, and then put it back into another qualifying plan. That's the only time that you're limited on how many of those types of transactions you can do is if you've taken the money personally as an indirect rollover. Remember, direct rollovers are not limited for any given taxable year. So what are some options that you have? You've made the decision to self-direct. You've made the decision to take control of that old 401k and move it to something that you can have tighter control over. Well, that's great, but what are the options that are going to be out there to you? As I previously mentioned, the bulk of what we administer for our clients is going to be real estate based. Whether that is real estate directly or the lending aspect of it is kind of split down the middle. About a half to 40% of our clients lend, and then about a half to 40% of our clients elect to buy real estate directly. Now, buying the real estate directly is going to involve a few different things. There's a few different ways to strategize around that. Some people will buy it to get the cash flow of rental and then avoid taxes on any ordinary income that would be generated from that rental of the property. Some people will elect to do a fix and flip, where they buy a property for a cheaper price, put the money into it out of their IRA that they rolled over from their 401k and fix it up and then sell for a profit. Again, then you're avoiding any ordinary income if you rented it during that fix. And then also any type of capital gains would be avoided when you sell it for a profit as well. So understanding that you have both sides of the coin that you can participate on with an IRA from a 401k rollover is very important, because if you don't want to be dealing with coordinating tenants and contractors for fixing a property, maybe lending someone a note and mortgage on a piece of property would be a better fit for you. Now, further than that, there's things like single member LLCs or private equity investments, startup companies, and cryptocurrency. All these different types of assets are going to be available to you if you're willing to go out, do the research, and actually pursue them within the self-directed IRA. Keeping in mind that we're not going to be providing you with any type of list of what is going to be able to be purchased from us directly. You're going to have to go out and find it, but we're going to be able to help you structure the different types of investments within your account, whether that be things like real estate, private stock in an upcoming pre-IPO company, futures accounts, oil and gas, single-member LLCs, commercial joint ventures. If you can kind of think it up, we can typically find a way to make it work. Now, just like with anything in life, especially with investing and tax deferment, there is going to be some asterisks associated with that. Now, these are going to be specifically whom you can and cannot deal with the new IRA that you've brought over from an old 401k, and also whom you cannot deal or what you cannot deal in. So the people that you cannot deal with are what's termed disqualified persons, and any type of direct transaction with one of these people can potentially cause a lot of issues for your IRA, and obviously we don't want to do that. So the people that you cannot directly deal with are going to be your spouse, your mother and father, or your son and daughter. The technical term for this is direct lineal descendants and ascendants of you personally being the account holder. And you can draw this line from any other person in that family tree as well. So your child's IRA cannot buy something from you, and your IRA cannot buy something from your child, and your IRAs cannot do business together. That does not mean you cannot partner them together. The correct way to partner is what's called a tenant in common partnership, and we have whole presentations dedicated to that, but essentially in the most basic term is that you define the percentages of capital contribution and ownership on whatever titling that the investment has. So in that case, for a piece of real estate, each person, their IRAs or the two disqualified persons would be named as percentages of undivided interest on the deed. That sounds a little complicated, I do apologize, but just understand you can partner with disqualified individuals, you just cannot directly purchase from them. So if you start it from the beginning, it can be doable, but after you have purchased something, you cannot convey or sell to a disqualified person. And they can also not receive a direct benefit from the property as well, meaning if your IRA owns a piece of rental property, you cannot then in turn rent it out to your son, daughter, spouse, or parents. Now, the options are going to be very wide with a self-directed IRA, but there are going to be a few things inherently that you cannot purchase. One, your IRA cannot be the direct holder of a life insurance policy, and you cannot own anything that derives its value from subjectivity. Things like antiques, alcohol, artwork, stamps, and coins. Now, you can buy certain coins that are traded on their bullion content value, but you cannot buy anything that would be inherently traded on the scarcity of it being a rare object, like a gold American Eagle from the turn of the century that is worth $1 million. Obviously, it is not $1 million worth of gold in that coin, so that is where the differentiation is drawn. So anything besides assets owned by a disqualified individual and things that are not life insurance or collectibles are going to be fair game for what you can do with your old 401k. And I know I kind of probably should have mentioned this in the beginning of it. I use 401k kind of across the board to refer to any type of retirement plan that you participated in with an employer. Now, that can be anything from a 401k plan like we're all familiar with, a 403b plan, a governmental 457, the Florida Drop Plan, the Armed Forces and DoD and Governmental Thrift Savings Plan. There are a myriad of different types of plans out there that can be utilized in this fashion. Now, understand that the main thing to look for, obviously I can probably name those off all day with different types of plans. If you participated in a retirement plan that you put money into out of your paycheck and your employer matched a portion of it or potentially didn't match, but if you had a job that you contributed money in out of your paycheck, 9 times out of 10, those funds can be rolled over to an IRA. So don't get too hung up on the title of this presentation necessarily or the actual title necessarily of the plan. It's always something that we can take a look at on a case-by-case basis and make sure that that is going to be a qualifying plan. But again, most of the time, so long as you were contributing money out of your paycheck, whether that is deductible or non-deductible, you can typically roll that into a type of IRA that you can self-direct. Now, since I mentioned that we don't provide you with a list of things to purchase in your IRA, that you actually have to do the legwork, that's actually for the most part, a very good thing because it allows you to not only invest in what you know, but invest with the people you know as well. So just like with everyone in life, you've built a network of people around you. And I use network to term everyone from professional to personal friends, but everyone essentially in the long term of things is going to need money or is going to need to invest or save. So the ability for you to use your network of people that you have built long-term social ties to in order to help further your investment. People that you know and trust is a really big, powerful tool that is, not necessarily something that we offer directly at Advanta, but is kind of a added benefit to doing this type of investing, is that you get to take the money out of that old retirement plan that had a investment advisor that you had never met, that probably lived in a different state, that was charging you fees for, just kind of sitting back and collecting that paycheck. You get to now take control of that and invest in the things that you are specifically doing the research on, that you know and feel comfortable with, and that you've determined are a good fit for your particular retirement planning. So it's a really powerful aspect of this that is kind of hard to really maybe put into words or put on paper, but understanding it is very important when looking at the ability of self-direction and what it actually means for you as the individual in your investment strategy. Now, it's all well and good to understand that you can use your old retirement plan to purchase these types of assets, who you're going to be finding these deals from, but, how does it work mechanically? What exactly do you do when it comes time to put pen to paper and sign a contract, or, go buy something or lend someone money? How does that work? And the answer is it's pretty simple. There's really not a whole lot of stuff to remember mechanically with this, but there are some very big guiding principles. The big guiding principle is that if you buy anything in your IRA, it has to be titled in the name of the IRA. You're not putting this in your personal name and then selling it back to your IRA. You're not, excuse me, you're not assigning things. Things need to be in the name of the IRA from start to finish. Now, how exactly do you do that? The naming convention that we use is going to be Advanta IRA for benefit of FBO, your name, and account number. That is what's going to go on the purchaser on a contract. That's what's going to go as the lender of the note, the holder of the private shares in the company that is raising capital. That is what's going to go on anything related to the investment. And then keep in mind that all of the funds for the purchase of this asset, whether it be real estate or a note or private stock, is going to come directly from the IRA. And then all of the income, whether it be from the appreciable value at the time of sale or the rental income or the dividends, all come back into the IRA tax-free. Now, it doesn't matter if you have a Roth IRA, a traditional IRA, a SEP IRA, an individual 401k, there's going to be no taxes paid on the general life cycle of that income. So if you have an asset that's spitting off dividends or rental income, the only time that you have to worry about taxation is just going to be at the very end of the life cycle of the account, when you take money out personally. That's the only time that you have to really kind of concern yourself with the taxes in this scenario. So just understand it doesn't necessarily matter what you are purchasing, what type of account you're purchasing in. The tax exemption for what it is generating is going to be maintained very similarly between all of those. Now let's look at some of the general rules. You have to find the investment. It needs to be newly acquired. It can't be something that you already have that is going to be conveyed into the account. The investments cannot be personally owned. And all of the expenses have to be paid from the IRA. So if you're looking at something, let's say you've been thinking about getting involved in real estate and you really want to, get into doing a fix and flip. Well, all of the funds for that fix and flip have to come from the IRA directly. You cannot, kind of cover a shortfall personally with that. So you have to make sure that you have enough funds coming over from that old employer plan in order to cover those types of expenses. And then all the income comes back as well for that type of investment. Now, what does it look like practically? Excuse me. When it comes to actually investing in something? Well, here's an actual case study that I drew from what a client had actually done. Obviously, numbers have been rounded, names have been changed, addresses is obviously not correct, but it goes to illustrate what maybe not necessarily the most average investment is, but what some clients have actually seen when it comes to deferring taxes. I'm going to point out something really interesting here in a moment. So John Smith identified a property being sold as a short sale. He put in the offer, and it was accepted at $120,000. Now, he had $120,000 that he had brought over, or he had more money than that. I believe, if memory serves me correctly, it was about $150,000 he brought over from an old employer's 401k plan. He closed the deal in the IRA, wiring $120,000 to closing. He decided to rent the property out for $1,200 a month for 2 years. So let's call it $28,000 of income that he received. Obviously, there's some expenses. He had to pay property taxes and things like that. He decides in 2 years to sell the property for $170,000. Now, remember, he bought it for $120,000, sold it for $170,000, so that's a $50,000 spread between what he paid and what he got. And then also the $28,000 of rental that he got is about $78,000 in profit that he realized with that. Now, the nice thing is that, obviously, like I said, there's going to be some expenses with that. But since he is not having to escrow taxes, not having to hold anything back, he can go from that $120,000 investment in 2 years, then having $198,000 to invest without having to pay taxes or hold anything back. So he can start compounding the amounts of money much quicker into new investments that he can in turn turn around and do. So the ability to do more deals quicker and bigger is really kind of illustrated with this, because if you were having to hold back some taxes, or you were having to not take all of the money directly that you'd like to invest and hold some back, it's going to certainly limit the amount of deals that you can do in a given year and how quickly you can potentially build something up, especially if you're having to play a lot of games with taxes. Now, buying property is great, and as I mentioned, all of the expenses have to come from that. So real estate directly is going to be a pretty labor intensive, and I say that with a few caveats of type of investment. There is a lot of active things that have to be done with a piece of real estate. You're going to have to make sure that tenants are qualified, and that anything that needs to be taken care of with the property is repaired and fixed. Things like HVAC systems, roofs, screened enclosures, appliances, plumbing, electrical, all those kind of things have to be taken into consideration when purchasing an asset in the IRA, especially if it is real estate. So if you are buying it directly, you're going to need to have either a property manager or be well enough versed to have people that can actually go and do the work for you, because you can't do it yourself. And then also having enough money on hand to potentially pay for those types of repairs that need to be done. Now, the upside is that if the property increases in value, you get to participate in that equity increase in the property. So in this case, the $50,000 of value that increased, the IRA got to capture that. No one else did. The IRA was the owner, bought it for $120,000. The old adage of buy low, sell high applies in full force here, and all the income derived from that asset is collected by the IRA as well. So the $78,000 in 2 years is solely the benefit of the IRA. Now, there's a lot of other things that go into that. Like I said, you have to consider all the expenses that go there. So maybe you don't want to be as hands-on. Maybe you like something that allows you to, have a little bit more of a hands-off approach and maybe mitigate some liabilities and issues that you would have with real estate. The other side of that is going to be lending. Now, you can take your IRA and you can lend it to someone for the purchase of real estate, or the purchase of anything, really. You're making an investment, not so much in the piece of real estate in this case, but in the person's ability to repay you, obviously, at the agreed upon interest rate and payment schedule. So you can lend someone money and then they purchase a home. Then you hold the mortgage, just like you're familiar with doing it personally. If you have purchased your personal residence and the bank holds the mortgage, your IRA can be the bank. It can hold that loan that someone has used to purchase a piece of real estate. If they fail to repay you, your IRA can foreclose on that property and then take back property in repayment for the loan. You don't have to have security to it. You can do unsecured loans. However, they are inherently much riskier, and the collection in the event of non-repayment is much harder. You can lend businesses money. You can lend investors money. There's no type of right or wrong way to do this per se. You just need to make sure that you've done your research on whom you're investing in, what the collateral is, and their ability to repay. But you have a lot of flexibility with regard to what type of return you're seeing in an IRA when you lend someone money. Excuse me. You get to set the rate at which your IRA will grow. So if the going rate in your area is 9% interest over 15 years for private loans, you can kind of just hit the button and set your IRA to grow at 9% over the next 15 years. However, there is inherent risk with some of this. You do have to qualify the people you're lending money to, but you're not so much set on the value increases of the property to where you're going to be making your money. So whereas John Smith, in the first case study, if that property went down in value, so long as it's rented, he could still make some money, but he could not sell it for a profit. Whereas this individual, if you lend someone money at 9%, even if the real estate market goes down, so long as they're still making payments on the property, you're still making 9% of your money, irregard as to whether or not the property has increased or decreased in value. But you are giving up the ability to capture that equity increase in the property value. So just understand that there is some give and take to this. Essentially, you also do maintain a little bit less liability with regard to lending as opposed to buying a piece of property, because if you bought a piece of property outright in your IRA, any liabilities associated with the actual owner of the property would be passed back to the IRA. So if someone slips and falls, or there's a libelous action associated with that property, the owner is the one that gets sued. So if you are just the note holder and hold the mortgage to the property, your IRA is going to be shielded from that type of liability, but again, it also does not participate in some of the other benefits that you would have with owning the property directly. The maintenance costs are very low, so again, you don't have to worry about repairing toilets, roofs, electrical, plumbing, dealing with tenants and stuff like that. You just, after you have lent the money out of your IRA, there isn't much to do except kind of sit back and collect the money into that account. And then you can also partner with a bunch of individuals to make a larger loan happen much easier than you can partner with a lot of individuals to make a property purchase happen. So understand that the flexibility and the ability to make different structures work is very well illustrated with doing loans. The amount of different ways you can do them is much greater than the amount of different ways you can buy real estate. At least just what we see with regards to IRAs and what people have seen to have a good benefit and have done in the past. Now, here's some illustrations of what a loan would look like, or how people have structured loans within IRAs here at Advanta. So one of our larger accounts that we have here at Advanta does only lending. That is, what they've made a good business of. They have a network of investors in South Florida that fix and flip properties. So all the loans are going to be secured by a first mortgage. So the IRA here lends the money out. It goes to a title company. There is a recorded first mortgage, a policy of lender's title insurance on it. There is terms of the note that there will be maybe repayment penalties. There is different things like that written in. So if they flip it really quickly, the IRA gets a little bit more money back if there is not a certain amount of seasoning on that note. And then all interest and payoffs are paid back non-taxable to the IRA, and then all distributions from that account holder's account to himself personally are tax-free as well. So depending on what your structure is and who you can really kind of make a lot of different structures work. You don't have to just say, oh, well, 2 years and $50,000 like John Smith had in the first real estate purchase is really attractive. You can make things work like lending very well if you have the network of people to help you maintain that type of income stream. So I've mentioned there is no type of regulation as to having a certain amount or type of security to a loan, albeit there is potentially less risk when looking at being able to be made whole if there is not payment on the note with a secured first mortgage. There can potentially be higher returns seen with unsecured lending because inherently there is not recorded security. In this case, Jane knows a contractor that flips properties. She lends him money from her IRA to complete the last part of rehabs just on a very short-term basis. Now, she lends them the money at a much higher interest rate. I believe in this case it was between 12 to 15% for the few weeks that he needed the money, and then all of the interest-only payments for the term of loan are paid back to the IRA, and the loan is repaid when the project's finished. Now, one thing you do need to make sure, you do have the ability to be very flexible with this, but you do need to make sure that if you are going to be lending people money, that you follow all state and local laws with regards to those, especially with regard to usury laws. Now, if you're not familiar with what usury is, it is the amount of interest that can be charged on a loan in a given state. Some states have very stringent regards as to what is considered a usurious rate. Some don't. Please check with your local regulations to make sure if you do lending in a certain area that you are doing it compliant, because although you do have the ability not to pay taxes on anything you are getting from some of these different types of assets, all of the local regulations and federal regulations are still going to apply with regard to what exactly you are doing. The taxation exemption is only a small part of this, so just make sure that you are following any and all rules with regards to what you are doing within that particular account. Now, some things I'd like to leave you with just so that you understand exactly what the considerations for things that you can and can't do. If you are looking to utilize your old 401k, understanding the basics is really a very important thing. So investing in gold and silver coins, certainly something you can do, but you cannot invest in a rare gold coin. Selling an IRA property, remember I mentioned there are certain people you can and can't deal with. You can deal with siblings, so you can sell that property to your brother, but you cannot sell it to your son or daughter, and you cannot sell it to your spouse or your parents. So understanding that there are certain people that you can and cannot deal with is very important in this. Fixing the IRA property, so if you've actually bought a property with your old 401k, funds in an IRA, you cannot fix it yourself. You have to have someone else take care of those types of repairs for you. Now, it doesn't have to be a licensed contractor, but just like with everything in life, you typically are going to get what you pay for, and mileage will vary. I would always recommend using someone that is licensed and qualified to do the work that you are having done to your IRA property. Do it, as opposed to taking the risk with someone that maybe is not licensed and maybe not as well versed in the type of things that need to be done for that. And again, there's also no limitation on where you kind of source the properties, be it from a non-disqualified individual. So you can buy things like foreclosures on courthouse steps. You can buy tax deeds and tax certificates. You can buy things off the MLS. You can buy them from private sellers. You can buy your neighbor's house or the house down the street. Just think about what can be in my IRA, and typically you can make that kind of investment work. Don't get too hung up on where it's coming from necessarily. If you have a place that you'd like to source an investment from that you think might be a good fit, give us a call, and we're certainly happy to walk through the procedures and what would be allowable and not allowable in that particular scenario. So with regard to this presentation, I don't like to overload people, especially if you're just looking for what my options are out there. I like to kind of keep it short and sweet with regards to the basics of what self-direction is, what kind of accounts they can go into, what you can invest in on a very basic level. But I want to kind of get that fire started for people of asking the questions of, well, what am I doing with my old 401k? It's just sitting there. What can I invest in? So here's my contact information. If you have any specific questions, please give me a call, shoot me an email. I love going through this stuff with people. It is very interesting to see what people come up with, and we are very passionate about what we provide here for our clients and the ability that we give our clients to take back control of stuff. So that is the end of our presentation today. Again, stick around for a minute or two. If you have any questions, type them into the chat box. Feel free to reach out to me directly, but I do appreciate everyone attending here today. If you want to refer back to this, it will be on our YouTube channel probably later today or tomorrow for you to get any additional questions or go back over some notes if you'd like to. And again, all of our YouTube videos for any webinar that we've done are going to be hosted there on our YouTube channel. Go to advantaira.com to our Learning Center tab, and you can browse and figure out exactly what subject you'd like to look at, and there's probably a video that I've taught on it. So again, thank you very much. My name's Alex Perny. 727-754-9954 is my phone number, and APERNY@advantaira.com is my email. Thank you very much for attending today. Have a wonderful afternoon.